$10,000 invested at age 25 versus $10,000 invested at age 35. Same amount of money, same rate of return. The difference at retirement? Over $200,000. Not because one person earned more or invested smarter, but because of a mathematical principle that Albert Einstein reportedly called the eighth wonder of the world. I'm Sarah.
And I'm James. Today we're breaking down compound interest, what it actually is, why it works the way it does, and why the most important variable isn't how much you earn, or even your rate of return. It's something much simpler than that.
Let's start with the actual mechanics, because a lot of people hear compound interest and think interest on interest, which is true, but it doesn't capture why this creates exponential growth rather than linear growth. Here's the formula. The amount you end up with equals your principal, multiplied by 1 plus the rate divided by compounding frequency, raised to the number of compounding periods. A equals P times 1 plus R over N to the power of N times T.
So let's put that in plain language. Because nobody's going to remember a formula. Say you put $100 into an account earning 7% annually. After year 1, you have $107. Now here's where it gets interesting. In year 2, you're not earning 7% on your original $100. You're earning it on $107. So year 2 adds $7.49 instead of $7 flat. Year 3 earns on $114.49. That extra 49 cents from year 2 is now earning its own returns. That's the interest on interest part. But what people miss is that this snowball keeps getting bigger every single cycle.
And that's the key distinction. Simple interest is linear. You earn the same dollar amount every year. Compound interest is exponential. The dollar amount grows every year. The difference between linear and exponential growth over decades is the difference between a staircase and a rocket ship.
Let me give a concrete example. If someone starts investing $500 a month at age 25, earning a 7% average annual return, which is roughly the long-term historical average for the S&P 500 after inflation, by the time they turn 65, they would have contributed $240,000 of their own money over 40 years. But their account balance would be approximately $1.2 million. Now, if they wait until age 35 to start, same $500 per month, same 7%, they contribute $30,000 less over the 30 years, but their ending balance would be around $567,000. That's a difference of over $600,000 just from starting 10 years earlier.
And we should point out why that gap is so dramatic, because it's not intuitive. The first person had 10 extra years of compounding, but those were the last 10 years when the account balance was at its largest. The most powerful years of compounding are always the final years. When the balance is over $500,000, a 7% return is $35,000 in a single year, more than the annual contributions themselves. That's when the math truly takes over.
That's also why the rate matters. But let's be precise about how much it matters compared to time. If you get a 6% return over 40 years, you still dramatically outperform a 10% return over 20 years. Time gives the exponential curve room to bend upward. Rate helps, but it can't make up for lost decades. The math simply doesn't allow it.
There's a useful shortcut called the Rule of 72 that helps estimate this. Divide 72 by your annual return rate. The result is approximately how many years it takes your money to double. At 7%, 72 divided by 7 is about 10.3. So money doubles roughly every 10 years. At 10%, it's about 7 years. At 4%, which is closer to a high-yield savings account these days, it's 18 years.
Here's why that's such a powerful framing. If you're 30 years old and your money doubles roughly every 10 years at 7%, that means by 40 you've doubled once, By 50, you've doubled twice. By 60, you've doubled 3 times. $1 becomes 2, becomes 4, becomes 8. 3 doublings, an 8-fold increase, in 30 years. Now imagine if you stretched that to 40 years. 1 becomes 2, becomes 4, becomes 8, becomes 16. 4 doublings. That 4th doubling adds more value than all previous doublings combined.
Now let's talk about where compound interest actually shows up in people's financial lives, because it's not just a theoretical concept. The most common places are retirement accounts, 401k plans, IRAs, TFSAs, RRSPs. These are tax-advantaged, which means the compounding happens without the government taking a cut each year. That's a massive advantage. In a taxable account, if you're paying capital gains tax annually, your effective compounding rate is lower.
On the flip side, compound interest also works against people. And this is where it gets uncomfortable. Credit card debt compounds against you. If you carry a balance at 18 to 24% APR, that debt doubles roughly every 3 to 4 years under the rule of 72. Someone with $10,000 in credit card debt paying minimums could watch that grow to $20,000 in about 4 years, without buying anything new. The same mathematical force that builds wealth can destroy it. The direction depends entirely on which side of the equation you're on.
And that brings us to inflation, the silent erosion that most people don't factor into their mental math. If inflation runs at 3% annually and your investment returns 7%, your real return, your actual increase in purchasing power, is about 4%, not 7%. The nominal number looks bigger than it really is. But here's what's important. Over long periods, even 4% real returns compound dramatically. The historical real return of the U.S. stock market after inflation is roughly 6 to 7%. That's still enough to double your purchasing power roughly every 10 to 12 years.
So why don't more people harness this? It's not that the math is hard. As we've seen, it's actually quite straightforward. The challenge is behavioral. 3 things tend to trip people up. First, they start too late. They think they'll catch up later, not realizing later is when the math is least forgiving. Second, they withdraw too early. They see a balance grow to 50,000 and think, I could use that, not realizing that 50,000 is the seed for the next doubling. Third, they chase high-risk short-term gains, looking for 20% returns next year instead of 7% returns for 40 years.
There's a psychological concept called hyperbolic discounting that explains a lot of this. Humans are wired to value immediate rewards far more than future rewards, even when the future rewards are objectively much larger. $1,000 today feels more valuable than $10,000 in 20 years, even though mathematically the $10,000 is worth far more. Overcoming that instinct is arguably the hardest part of the entire equation.
And let's be clear about what this isn't. Compound interest is not a get-rich-quick mechanism. At 7%, it takes about 10 years to double your money. That's slow, painfully slow for the first decade. The first doubling feels like nothing happened. The second doubling feels modest. It's the third and fourth doublings, decades in, where the numbers start looking extraordinary. The people who benefit most from compound interest aren't the ones who made the highest returns. They're the ones who simply stayed in the game the longest.
That's probably the single most important thing to understand about all of this. Compound interest isn't a secret. It's math that anyone can use, and the formula fits on a single line. The hard part isn't understanding it. It's having the patience to let it work for decades without pulling the plug early. It's resisting the urge to check your balance every day, to panic during downturns, to withdraw for short-term wants. The math works every time. The question is whether the person using it can stay out of its way long enough for it to do its job.
If you take one thing away from this conversation, let it be this. Time in the market or time in any compound growth vehicle consistently outperforms timing the market. Not because timing is impossible, but because giving the exponential curve room to bend upward is the most reliable force in personal finance. Understanding how it works is the first step toward making decisions that let it work for you.
Thanks for listening. If this helped you understand compound interest, subscribe for more conversations that break down the financial concepts that actually matter. We'll be back next episode to explore another pillar of financial literacy. Same time, same place.